One of the common questions I get is how much do I need to start day trading? And my answer is you can start with however much you want, but if you're looking to start with a smaller account, you may be limited to the amount of day trades you can take. This is all thanks to the PDT rule, or the pattern day trading rule, that was established back in 2001 by the SEC. And this rule states that any margin account that does not maintain over $25,000 will only be limited to 3 day trades in a 5-day rolling period. So what does that exactly mean? Well, a day trade is when you open and close a position the same day, and you will only get 3 of them, and each one you use will not be available again until 5 business days later. Think of them as tokens to an arcade. You only get 3 tokens to play the game, and each token you use, you don't get that token back for 5 days. So if you use all 3 tokens on a Monday, you won't have any tokens to trade with until you get them back on the following Monday, since they don't count weekends. Or let's say you use a token on Monday, second on Wednesday, and third on Friday, then you would get token number 1 back on the following Monday, token 2 on the following Wednesday, and token 3 back on the following Friday. So you can see how this not only limits the amount of day trades you can take, but also when you can take them, which is not the most optimal way to day trade, because every day is a unique day in the market, and you never know when the next opportunity will present itself. And when you also factor in the possibility that the 3 trades you do take may not work out the way you want, and the next trade you aren't able to take because you ran out of tokens may end up going to the moon. So this also puts you at a disadvantage when trying to let probability work in your favor. But don't worry, I wouldn't make this video if I didn't have solutions for you, so let's go over some now. First, let's start with a popular solution, and that is to trade with an offshore account. Brokers outside of the US are not subject to US regulations, which means no PDT rule. You also don't need a minimum of $25,000 or even $2,500. All you need to do is maintain as little as $500 in your account to day trade all you want. Much more reasonable, right? But using an offshore account is a double-edged sword. For the same fact that it's not regulated by the US, I can't really say that your money will be 100% secure. Now, it may be unlikely that something will happen with some of these popular offshore brokers like CMEG, which is one of the brokers I use, but it's something to keep in mind when choosing an offshore broker. They also do charge commissions and fees, and the platforms they offer have monthly fees as well. Now, I don't use mine to trade with. The only reason I have one is because I really like the level 2 window on Sterling, which is one of the platforms they offer. So I can use that with only tying up $500 of my capital into that account while still executing my trades with a US based broker. And if something unfortunate were to happen to my offshore account, I'm only out that $500. If you want to know about all the platforms I use and what I like to look for, I'll link a video explaining all that right here. So if you're going to go this route, use your best judgment. Don't go with one that looks shady. Make sure you're aware of all the fees that come with it, and try to withdraw your profits often and not keep too much funds into that account. The second solution is to use a cash account. The PDT rule only applies to margin accounts, so using a cash account will give you the freedom to day trade with whatever account size you have. But the problem with cash accounts is 1, you're not getting the leverage that margin accounts give you. 2, you can't short stocks. And 3, you have to wait until the cash settles after each trade. Similar to how you have to wait for checks to settle in your bank account. For example, let's say you have $5,000 in your cash account and you use that entire $5,000 to make a day trade. Now you have to wait 2 days for that cash to settle before you can use that $5,000 again. A way around this is you can just use half of that. So you can use $2,500 to trade on Monday, then the other $2,500 to trade with on Tuesday, and by Wednesday, that first $2,500 will be settled by then, giving you the ability to make 1 day trade every day. Yes, this still limits the amount of day trades you can take, but if you can properly plan out the allocation of your money throughout the week, you can possibly make more than 1 day trade per day, which is a better alternative to the PDT rule. But again, you will not be able to short in a cash account, so you'll also be limited to only playing on the long side. So another option, which is my personal favorite, is to take the money you have and make a trip to your nearest casino. Here you can try your luck at one of the table games. I recommend something like roulette because they pay up to 35 to 1, which will get you to that $25,000 much quicker. Okay, don't do that, but for real, the last option I have for you, which is probably what I would do, is to just trade under the PDT rule, but using multiple margin accounts. So if we take that same $5,000 from the cash account, and instead we open 2 separate margin accounts with $2,500 each, then I'm still getting that 4-to-1 leverage, meaning I have a buying power of $10,000 on each account. I will also be able to play both long and short, and I can sleep comfortably knowing my money is protected and secured. But the drawback would still be that I only have 6 day trades in a 5-day rolling period, but I wouldn't be too worried about that when I'm starting out because my goal isn't to be taking as much trade as possible. It's about taking the right trades. Some days you may find the market to be very active, and some days it could be completely dead. Don't think that you need to be trading every minute, every hour, every day, because that's not the case at all. Focus on taking the right trades, and if you run out of trades, I would move over to a paper trade account and continue trading on that. This way you're still able to track your trades, get your reps in, and build your experience. When I first started, I started with 30,000 just to get past the PDT rule and was only using 5,000 of that to actually trade with. So just start with what you can. You have some options with smaller accounts. The important thing is to get started. If you found this to be helpful, hit that like button. If you have any questions at all, leave them in the comments down below. I'm here to help. Subscribe if you want more content like this one. And as always, I appreciate you for being here, and I hope to see you on the next one.